Investing for inheritance tax planning is considered by some as a critical part of balanced investment portfolio management. But the process of choosing stocks can be a bit of a minefield. Chris Boxall joins us now from Fundamental Asset Management for a quick trip around the space. Chris, you manage portfolios for this very purpose, don't you, for IHT planning. We're talking here about potential costly mistakes, aren't we?
Yes, a lot of private investors invest in AIM shares for inheritance planning purposes, but we become aware that a number of them don't really follow things terribly closely, which could mean that they have some very costly mistakes in the future for their estates. And there are a number of areas where they fall down on, really, and that's perhaps worth sort of covering a little bit.
What sort of, we'll cover that in just a minute, but in terms of the number of stocks on AIM, what are we talking about here in terms of proportions that are definitely not considered and those that are?
Broadly, in our last tool, and I've picked off, with the help of AIM Search, Investors Champion AIM Search service, that there were 964 companies on AIM at the end of July, and broadly the AIM Search service says that 685 of those fully qualify for inheritance tax planning purposes. There's no real ambiguity around them. So that leaves 86 that part qualify or where there may be some ambiguity around their qualifying status, and the remainder, for one reason or another, don't qualify at all. They may be investment companies, they may be dual listed, which are two reasons why they wouldn't qualify for inheritance tax planning.
Now we're talking here, aren't we, about business property relief, aren't
Absolutely,
we?
yeah.
So that's the phrase that we should watch out for.
Yeah, the business property relief rules are essentially there to protect proper trading companies. They're not there to protect passive investment companies or quasi-tax schemes, tax planning schemes. So you really have to, investors generally should apply some common sense that you're investing in a proper trading business that is trying to create wealth and grow, not just something that's got static money sitting there.
Now you use Investors Champion, I think. You put together this website of a list of stocks.
Fundamental Asset Management developed the Investors Champion AIM Search website to help largely private investors in seeking out qualifying AIM companies, and it's where companies don't qualify, it states why, and more importantly, where there is ambiguity, whether we consider it part qualifying, it's an odd term, part qualifying, we also, the AIM Search website explains that why as well.
Give us some examples of this. I think we've got MAB1 as a ticker, which we've got first of all, which I think is on the list to begin with. We're Mortgage Advice Bureau Holdings. Explain what's going on here.
Yeah, Mortgage Advice Bureau Holdings is a very nice business, and it has a number of operating activities. But the AIM Search tool reveals that there may be so-called accepted assets, because they're a business that, it's very efficiently run, but they have excess cash, and what they do with that is they make a number of passive investments. So one could consider this business as a quasi, or partly, an investment company. And it's not just a one-off. It's made acquisitions on a number of occasions and realised them in reasonably quick time. Therefore, AIM Search considers that this may part qualify due to these accepted assets. Now, the key problem is it's very hard to determine what part of the business may not qualify. If you hold 100,000 quid in or whatever, you're not actually sure what percentage may not qualify when the day of reckoning comes. Our view, Fundamental's view on this, is where there's ambiguities, we have to unfortunately steer clear of it, despite the fact we very much like Mortgage Advice Bureau Holdings. Well, steer clear of it in our inheritance tax planning portfolios.
Give us an example of another one.
Well, another one we've picked out here, where there are changing activities, is Hargreaves Services. Now, this is an interesting one, because Hargreaves Services has struggled for a number of years as its legacy activity has declined. It had some coal mining assets, and in association with that, it's got a lot of property assets. Now, its coal mining has declined. It's had huge costs to incur through the restructuring of its business, and it's seemingly turned itself more into a property investment company. Now, these are simply the restructuring of legacy assets into property investment assets. And there is another example on AIM called Robinson PLC, ticker's RBN, where this happened many, many years ago. And Robinson, it's very helpful that it provides a guide as to its tax status. It actually tells investors, look, these are the realisation of legacy assets, and from their perspective it would still qualify. But Hargreaves hasn't done that. So the big question mark is whether Hargreaves continues to qualify.
Who's the final arbiter then on this as to whether it does?
HMRC is the final arbiter. But HMRC, unfortunately, don't provide a comprehensive list of every company that qualifies. And you can understand that because, take the example of Hargreaves, its business is evolving very quickly. I mean, HMRC would have to employ people to review every single company on an ongoing basis. I mean, our job as investment managers is to look at these companies. That's our role.
Give us an example of one that is definitely not covered. I think on your website there's a big round X, isn't there, on one that's not covered?
Well, one recently that's now not covered is Hutchison China Medicare, which is a very popular business for investors, a very, very big AIM company. And AIM Search considers that it no longer qualifies, and the primary reason for that is it's now dual listed on the NASDAQ, and dual listing on a qualifying exchange, it means it doesn't qualify. So, for example, if it had dual listed on any other regulated like Frankfurt or Paris, it wouldn't qualify. It's got a dual listing of some of its securities on the NASDAQ. However, AIM Search considered even before this that it didn't necessarily qualify due to the significance of its investment in joint ventures, which, to all intents and purposes, look like investments, and they actually represent the lion's share of its revenue and its net income, not its revenue, its income. So AIM Search Investors Champion never considered there was always ambiguity before, but the dual listing absolutely whacked it. Yeah. There's no way it qualified.
One final question has to be about the change in emphasis and change in whether it's allowed or not allowed. How does one go about dealing with this?
You can use the AIM Search tools to give you an idea, but it's by no means supposed to be cast iron. It gives a very good steer as to whether things may qualify or may not, and it points you, as we've illustrated with Hutchison and Hargreaves and Mortgage Advice, so it points you in the right direction. Private investors should very closely analyse the balance sheet, the income statement, and the AIM admission document. There may be some clues in the AIM admission document. You're not going to get any help from HMRC, so don't think that. Best case as well, go to the company. We're aware that many companies, Robinson was an example, but other companies where there's ambiguity actually seek guidance from tax lawyers and can conveniently provide you with a nice piece of paper showing, yes, we've received guidance that is, by our accounts, we do fully qualify. But there aren't that many out there. Very, very amazingly, very few AIM companies are switched on to the appeal of their shares for inheritance. It's crazy. Yeah. It's the marketability of them.
Yeah. Whole point of it. Yeah. Chris, thanks indeed for joining us. Chris Boxall is from Fundamental Asset Management. Chris puts together portfolios for those wanting to invest for inheritance tax purposes.